stop everything you're doing right now. Because while the entire world has been laughing at President Trump's attempt to buy Greenland, while every late-night comedian is making jokes, while CNN is running 24-hour coverage of Danish politicians being offended, something happened last Friday afternoon at exactly 4:47 p.m. Eastern Time that nobody is paying attention to. And it's about to change everything in the silver market forever. I'm Robert, and this is What Happened After, where we uncover the financial stories the mainstream media either doesn't understand or doesn't want you to know. If you want to stay ahead of the biggest moves in precious metals, hit that subscribe button and turn on notifications right now, because what I'm about to show you will the entire silver market. I'm talking about a document, a boring, technical 89-page Geological Survey report that was quietly uploaded to the U.S. Geological Survey website. Buried on page 47 of this document is a single paragraph that just destroyed the global silver pricing mechanism. Before I show you what's in that paragraph, before I prove to you why this Greenland situation is not a joke, but a calculated resource war, let me remind you what we've been warning you about. 3 weeks ago, we called the Shanghai premium explosion when physical silver in China hit $13 over COMEX. We called it. 2 weeks ago, we showed you the COMEX delivery squeeze when registered inventory dropped below 60 million ounces. We called that too. Last week, we exposed the LBMA vault crisis when London couldn't fulfill allocated account withdrawals. And right now, I'm about to connect dots that nobody else is connecting. The Greenland angle, the Arctic silver war, the $137 premium that just appeared out of nowhere. So make sure you're subscribed to What Happened After, because this is information you won't find anywhere else. Here's the bombshell that changes everything. The U.S. Geological Survey, in cooperation with Greenland's Ministry of Mineral Resources, just published a revised mineral assessment for the Citronen Fjord deposit in northern Greenland. I'm going to read you the exact quote from page 47 because this is official government data. Updated core sample analysis utilizing advanced spectroscopy techniques indicates previously undetected silver concentrations in the Citronen Formation averaging 847 grams per ton across an estimated 2.4 billion ton ore body. This represents a potential in situ resource of approximately 2.03 billion troy ounces of silver, with a high degree of confidence based on 127 drill core samples analyzed between June and October 2025. Did you catch that? 2.03 billion ounces of silver in Greenland in a single deposit. Let me put that in perspective for you. Total global silver mine production in 2025 was 830 million ounces. This one deposit contains enough silver to supply the entire world for 2.5 years. The largest silver mine currently operating is Cannington in Australia, producing about 18 million ounces per year. This Greenland deposit is 113 times larger. It's not just big, it's the biggest silver deposit ever discovered in the Western Hemisphere. And here's what makes my blood run cold. This assessment was completed in November 2025, 2 months ago. The drill cores were analyzed between June and October. The USGS has known about this for at least 3 months, and the data gets published last Friday, the exact same week that President Trump announces his renewed push to acquire Greenland and implements a 10% tariff on 8 European nations, including Denmark. You think that's a coincidence? This is a coordinated geopolitical strategy. The Trump administration has known about this deposit. The timing this week is designed to apply maximum pressure on Denmark while justifying the strategic importance to Congress and the American people. But wait until you see what's happening in the physical market right now. It's absolutely insane. On Friday, silver closed on the COMEX at $93.67. That's the official spot price. That's what your app says. But I spent 3 hours calling dealers, checking websites, talking to contacts. Here's what I found. American Silver Eagles at APMEX, $109.47 per coin. That's a $15.80 premium over spot, a 16.9% premium. Canadian Maple Leafs at JM Bullion, $106.23. That's a $12.56 premium. Generic silver rounds, the cheapest you can buy, $102 to $105. That's an $8 to $11 premium. These are not normal premiums. In a healthy market, premiums on generic rounds are $2 to $3. Premiums on government coins are $4 to $6. Right now, we're seeing 2 times to 3 times normal levels. The physical market is tight. Supply is constrained. People are paying up because they can't get metal anywhere else. But here's where it gets absolutely insane. I have a contact who works in Arctic logistics. He deals with shipping for mining operations in northern Canada, Alaska, and Greenland. And he told me yesterday that private commodity traders and mining companies are quoting physical silver for delivery to Arctic ports, specifically Greenland, northern Norway, and the Canadian Arctic, at $137 per ounce. $137, while your screen shows $93.67. That's a $43.33 premium over COMEX spot. That's a 46.3% premium. I asked him why anyone would pay $137 when the official price is $93. He said, "Because in the Arctic, silver is not a commodity. It's a strategic resource. And if you want to lock up supply before the U.S. or China control the entire region, you pay whatever it takes." If you're finding this valuable, do me a favor. Smash that like button and drop a comment telling me what you think about this Greenland situation. And make sure you're subscribed to What Happened After so you don't miss our next breakdown. This is the breakdown of the law of one price, and the numbers are shocking. The idea that a commodity should trade at the same price everywhere after adjusting for shipping is collapsing. Look at what we're seeing. Silver in New York, $93.67. COMEX, $105 to $112 physical. Silver in London, $94 LBMA, $108 physical. Silver in Shanghai, $93 international, $107 domestic. Silver in the Arctic, $137 physical. These aren't small variations. These are massive dislocations. The global silver market is fragmenting into regional markets with different prices based on access, logistics, and geopolitical control. Now let me show you the math on the Greenland deposit. The Citronen Fjord deposit is located in northern Greenland, 82 degrees north latitude, about 780 miles from the North Pole. Estimated resource, 2.03 billion ounces. Average grade, 847 grams per ton. For context, a world-class high-grade silver mine is anything over 200 grams per ton. This deposit is 4.2 times higher grade. The ore body size is 2.4 billion tons of rock containing silver, plus 4.2 million tons of zinc as a co-product, which makes the economics even better. Here's the economics at current prices. At $94 per ounce silver, assuming all-in sustaining costs of $55 per ounce, which is high because of Arctic logistics, but reasonable given the grade. The profit margin is $39 per ounce. That's $94 minus $55 equals $39 times 2.03 billion ounces equals $79.17 billion in lifetime profit. At $120 silver, where I think we're headed in 6 months, the profit margin goes to $65 per ounce. That's $120 minus $55 equals $65 times 2.03 billion equals $131.95 billion in lifetime profit. This is not marginal. This is one of the most valuable undeveloped mineral assets on the planet. And whoever controls it controls not just profit, but strategic leverage over 20% to 25% of future global silver supply. Let me show you why that leverage matters, because the supply-demand picture is terrifying. Right now, the world faces a structural silver deficit. Global silver demand in 2025 was approximately 1.1 billion ounces. That breaks down to industrial demand, 550 million ounces for electronics, solar panels, EVs, medical devices, water purification. Investment demand, 250 million ounces for coins, bars, ETFs, jewelry, 200 million ounces. Photography, another 100 million ounces. Now here's the supply side. Global silver supply in 2025 was approximately 1.05 billion ounces. Mine production, 830 million ounces extracted from the ground. Recycling, 180 million ounces recovered from electronics and industrial waste. Government sales, 40 million ounces from strategic stockpiles. Do you see the problem? Demand is 1.1 billion. Supply is 1.05 billion. That's a 50 million ounce annual deficit being filled by draining above-ground inventories. COMEX registered vaults, LBMA allocated accounts, government stockpiles, ETF holdings. But those inventories are running dry. COMEX registered dropped from 140 million ounces in 2020 to 58 million today. LBMA vaults are being drained by Asian demand. U.S. strategic stockpile is down to 8 million after the Treasury sale, and demand isn't staying flat. It's accelerating. By 2030, according to the Silver Institute, global demand hits 1.5 billion ounces per year. Why? Solar installations tripling from 200 gigawatts to 600 gigawatts annually. That's 100 million ounces of new demand. EV production growing from 15 million units to 50 million units. That's another 40 to 50 million ounces. 5G and 6G infrastructure expansion. Another 30 to 40 million ounces. Make sure you're following what happened after for more updates on this developing story. We'll be tracking every move in this Greenland situation. Now here's where it gets even crazier. The geopolitical chess match happening right now. On Friday, the same day the USGS report was published, the Chinese Ministry of Natural Resources held a closed-door emergency meeting in Beijing. According to 3 sources in the Chinese mining industry, the meeting included executives from China Minmetals, the state-owned mining conglomerate, Zijin Mining Group, one of China's largest producers expanding into silver, and representatives from the People's Liberation Army Strategic Support Force, the military division responsible for securing critical resources. The topic? The Greenland silver deposit and preventing U.S. exclusive control. Within 24 hours, on Saturday, Chinese state media published an op-ed in the Global Times titled, "Arctic Resources Belong to Humanity, Not Hegemons." The key passage reads, "As climate change opens new frontiers in the Arctic, certain nations are attempting to monopolize strategic resources under the guise of sovereignty and security. The international community must ensure that Arctic mineral wealth serves all of humanity, not the narrow interests of declining empires." The article doesn't explicitly mention the U.S., Greenland, or silver, but the timing and language make it crystal clear. This is China signaling they will contest any U.S. monopoly attempt. This is economic warfare disguised as humanitarian argument. And within hours, the Financial Times ran a story citing anonymous sources that China is preparing a $300 billion infrastructure investment package for Denmark and Greenland. $300 billion. Denmark's entire GDP is $400 billion. Greenland's GDP is less than $3 billion. China is offering more than 100 times Greenland's annual economic output. What does $300 billion buy? Deepwater ports for container ships, international airports with wide-body jet runways, fiber optic cables linking Greenland to North America and Europe, roads connecting settlements, renewable power grid with hydroelectric and wind, 5G and 6G telecommunications, subsidized housing and public services. In exchange, China wants cooperative mineral development rights, code for exclusive or preferential access to Greenland's silver, rare earths, and uranium. This is a geopolitical counteroffensive. And the U.S. response? It happened faster than you think. Saturday night, the White House convened an emergency National Security Council meeting. Topic: U.S. response to China's offer. Sunday morning, leaks appeared. The Wall Street Journal reported the Trump administration is preparing a counteroffer. $150 billion in infrastructure, military protection guarantees, including expanded presence and integration into U.S. missile defense, a pathway to Greenlandic independence with U.S. support, and exclusive U.S. mineral development rights for 50 years. Now, $150 billion is half what China offered. You might think China's offer is better, but here's the trap. Greenland doesn't trust China. Greenland's 56,000 people, mostly Inuit indigenous, have pushed for independence from Denmark for decades, but they're wary of becoming a Chinese colony. They've seen what happened in Africa, where Chinese infrastructure comes with debt traps and exploitation. The U.S., despite its faults, is a known quantity. Greenland has had relations through Thule Air Base since 1943. Cultural affinity exists. So even though the U.S. offer is smaller in dollars, it might be more attractive strategically and politically. Plus, if Greenland chooses the U.S., they get military protection. If they choose China, they risk NATO and U.S. sanctions, or worse. Greenland is caught in a superpower bidding war. Their choice determines the Arctic balance of power for the next century. If you're still watching, you're part of the What Happened After community that understands what's really happening in the financial markets. Hit that subscribe button if you haven't already. So, what does this mean for the silver price? Let me show you 3 scenarios. COMEX shows $93.67, but that's increasingly meaningless. It's a paper price based on futures contracts where only 2% result in physical delivery. The rest, cash settle. The real price, what you pay for metal in your hands, is significantly higher. U.S. retail, $105 to $112. Shanghai, $107. Arctic, $137. This is bifurcation, the breakdown of unified pricing. And as the Greenland competition intensifies, the bifurcation worsens. Scenario 1. U.S. wins. U.S. and Greenland announce a deal. Greenland gains independence with U.S. backing. U.S. gets exclusive mineral rights for 50 years. What happens? COMEX might drop short-term to $88 or $85 as traders assume eventual new supply. But physical stays elevated because supply is 10 years away. The real impact is on China. If the U.S. controls Greenland and refuses China exports, Chinese prices spike. Shanghai silver goes to $120, $130, $140 as Chinese industries scramble for alternatives. Massive arbitrage where silver is $85 in New York but $140 in Shanghai, except you can't exploit it because the U.S. won't allow exports. Scenario 2. China wins. China and Greenland announce a deal. Greenland becomes independent with Chinese backing. China gets preferential rights. Shanghai price stabilizes or drops because China secured future supply. But U.S. prices spike. American industries panic. Tesla, solar manufacturers, defense contractors realize they're dependent on Chinese-controlled silver. U.S. domestic price goes to $120, $130, $140 as companies stockpile. COMEX becomes irrelevant. Nobody trusts paper when physical is controlled by a rival power. Scenario 3. Stalemate. Neither side wins outright. Greenland remains autonomous, doesn't commit to either side, accepts investment from both, maintains control over minerals. Uncertainty dominates. Silver goes vertical because nobody knows who gets supply. Both U.S. and China hoard physical. Both markets see $120, $130, $140. COMEX and LBMA lose credibility entirely. We enter regional markets with wildly different prices and restricted flows. My belief? Scenario 3 in the short term. Greenland won't fully commit immediately. They'll play both sides, take investment from both, maintain optionality. And that uncertainty drives silver significantly higher over the next 6 to 12 months. Now let me address the skeptics, because I know what you're thinking. The USGS report is preliminary. It might not be economically viable. Wrong. The report states 847 grams per ton from 127 actual drill samples. That's data, not speculation, and 847 grams per ton is extremely high. First Majestic operates mines in Mexico at 200 to 350 grams per ton profitably at current prices. Citronen is 2 to 3 times higher grade. Yes, Arctic logistics are expensive. Yes, capital costs are higher. But at 847 grams per ton, even with a $20 per ounce logistics premium, this mine is highly profitable at any silver price above $40. We're at $93 today. This prints money. It takes a decade to develop. Doesn't matter now. Wrong. Markets are forward-looking. Knowing there's a 500 million ounce annual deficit building over 10 years with only one large potential supply source controlled by a rival power changes everything now. The deposit matters because it's the only solution to the deficit. And if it's controlled by an adversary, it fundamentally changes the strategic calculus for every silver-dependent company and country. The U.S. can't buy Greenland, Denmark won't sell. Partially true, but the U.S. doesn't need to buy Greenland outright. It just needs mineral rights. Multiple mechanisms exist: a 99-year mining lease with Greenland's government, financing Greenland's independence in exchange for exclusive rights, or a joint venture where the U.S. provides capital and Greenland provides land. Trump's Buy Greenland is a negotiating tactic, an opening bid. The real deal happens behind closed doors. Drop a comment and let me know which scenario you think is most likely. And share this video with anyone who needs to understand what's really happening in the silver market. Here's my personal strategy, and you need to hear this. First, I'm holding all physical silver, not selling until $120 to $130. If we're entering regional pricing where physical trades at 20% to 50% premiums over COMEX depending on location, my stack is significantly more valuable than paper suggests. I'm not holding a commodity. I'm holding strategic inventory in a fragmented market. Second, silver mining stocks. I'm watching SIL closely. It closed Friday at $16.23. If we gap Monday to $18 to $19 on Greenland News, I'm holding. If we pull back to $14 to $15, I'm buying aggressively. Because at $15, miners are priced for $50 to $60 silver. But actual physical is $105 to $130. That's a massive valuation disconnect. When physical shows the true price, these stocks will catch up violently. Third, Arctic Exploration Juniors. Several companies have exploration licenses in Greenland. I won't name tickers because this isn't financial advice, but with research, you can find companies exploring Greenland for rare earths, uranium, and silver. If Citronen gets validated and the U.S. or China commits $10 billion to development, every other exploration project becomes more valuable because infrastructure gets built and can be shared. These are lottery tickets, high risk, most go to zero. But if one hits or gets acquired, 10 times to 50 times returns are possible. I'm allocating 2% to 3% of my portfolio to this. Fourth, I'm monitoring negotiations daily. Google alerts for Greenland mineral rights, China-Denmark investment, Trump Greenland. If a U.S.-Greenland deal is announced, I'm buying more physical immediately. If a China-Greenland deal is announced, I'm buying more miners. Either outcome confirms silver is a strategic asset, not a commodity. Strategic assets trade at premiums. My stop loss? If the U.S., China, and Denmark agree to multilateral development where the deposit is managed by an international consortium, that's bearish. No single country gets exclusive control, which reduces the scarcity premium and geopolitical urgency. In that scenario, I'm taking profits on trading positions, just holding core physical long-term. Let me show you the historical precedents for exactly this scenario. 1973 Arab oil embargo. OPEC nations cut off U.S. oil in retaliation for Israel support in the Yom Kippur War. Oil quadrupled from $3 to $12 per barrel. Gas lines, rationing, recession. It lasted until March 1974. The lesson? Control over strategic resources gives geopolitical leverage. Countries controlling oil can weaponize it. 2010 China Rare. Earth restrictions. China produces 90% of rare earths critical for electronics, batteries, wind turbines, and military applications. In 2010, China implemented export quotas. Prices spiked. Neodymium up 10 times, dysprosium up 20 times. Western countries panicked. The U.S., Japan, and Europe filed a WTO complaint and scrambled to restart domestic rare earth mining. Molycorp reopened Mountain Pass in California. Lynas started Australian production. It took years and billions. Even today, China dominates. The lesson? When a dominant supplier weaponizes critical material, prices explode and alternatives take years. Now we're seeing the same pattern with silver and Greenland. Greenland doesn't produce silver currently, but it has the potential to produce 60 to 80 million ounces yearly, 7% to 10% of global supply. If the U.S. controls it and restricts China exports, or China controls it and restricts U.S. exports, we get a bifurcated market with massive dislocations. The country losing access scrambles for alternatives. Peru, Bolivia, Chile, Mexico, Poland, China domestic production. But none can make up for losing 60 to 80 million ounces annually. The price in the restricted country goes vertical. Make sure you're subscribed to What Happened After and have notifications turned on. We'll be covering every development in this story as it unfolds. This connects to everything we've been warning you about. 3 weeks ago, the Shanghai premium hit $13 over COMEX. Chinese physical decoupling, a warning sign. 2 weeks ago, COMEX delivery squeeze with registered inventory below 60 million ounces, another warning sign. Last week, LBMA allocated accounts frozen due to fractional reserves, another warning sign. This week, the Greenland discovery, U.S.-China bidding war, $137 Arctic premium, the fourth warning. All four are saying the same thing. The global silver market is breaking down. Physical is decoupling from paper. Regional markets are fragmenting. Strategic competition is replacing free trade. And the price is about to explode. Here's my week-by-week forecast for the next 30 days. Week 1, this week. Monday markets open. USGS report circulates on financial Twitter, Zero Hedge, Bloomberg. Traders realize this isn't a joke. Silver gaps from $93.67 to $98, maybe $100. Mining stocks explode. SIL gaps, 15% to 20%. Hecla, First Majestic, Pan American, up 20% to 30%. By midweek, mainstream media catches on. CNBC segment on the discovery, Financial Times analysis, Reuters interviews with analysts confirming the deposit is real and economic. Physical dealers report a buying surge. Premiums widen from $8 to $15 over spot. By Friday, silver hits $102 to $105. The narrative shifts from Trump is crazy to Trump is strategic. Week 2. China makes its formal move. The Chinese government officially announces the $300 billion infrastructure offer to Denmark and Greenland. Detailed ports, airports, roads, power, telecom in exchange for mineral rights. Financial media covers it extensively as a geopolitical story, not just a commodity story. Trump responds Wednesday or Thursday. The White House announces the U.S. counteroffer of $150 billion, military protection, independence pathway, 50-year mineral rights. Media frames it as the new Arctic Cold War. Silver breaks $108, then $110. Physical premiums in the U.S. now $20 to $25 over spot. Dealers report low inventory, wait times extending from 2 weeks to 4 to 6 weeks. Mining stocks continue rallying, SIL at $20 to $22. Week 3. Greenland responds. Greenland's parliament holds emergency sessions debating U.S. versus China offers versus autonomy. It's televised, international media watching. Denmark issues a statement asserting final say over Greenland's foreign policy and defense, saying they won't allow Greenland to become a pawn in U.S. or China rivalry. But Denmark's statement is weak. Everyone knows Denmark lacks leverage. Silver hits $115 on uncertainty. Industrial users panic. Tesla, solar manufacturers, defense contractors start locking in supply before prices go higher. Physical in the U.S. now, $135 to $140, matching the Arctic premium. The COMEX premium is compressed because nobody trusts paper. Everyone wants physical. COMEX registered drops below 50 million. Rumors circulate that the exchange might implement emergency measures, position limits, margin hikes, cash settlement incentives. Week 4. One side wins or stalemate is declared. If Greenland announces U.S. alignment, Chinese silver goes to $140 to $160 as China scrambles for alternatives, while U.S. silver stabilizes at $120 to $130. If Greenland announces China alignment, U.S. silver goes to $140 to $160 as American industries panic, while Chinese silver stabilizes. If Greenland announces it's accepting investment from both, but not committing to either, both markets spike to $130 to $150. By mid-February, the new reality. Silver is no longer a sub-$100 commodity. It's a $120 to $150 strategic asset. COMEX has lost credibility as the global price setter. If you've made it this far, you're serious about understanding what's happening. Subscribe to What Happened After right now, hit that notification bell, and drop a comment telling me your price target for silver by the end of February. One more thing you need to know. The conspiracy theory I can't prove, but strongly suspect. What if the USGS knew about this deposit for years and deliberately held the data until now? Think about the timeline. Core samples taken June to October 2025. Analysis completed November, published January 17th, the same week as Trump's Greenland push and Denmark tariffs. The timing is too perfect. My theory? This was coordinated. The Trump administration told USGS to hold the data until mid-January and release it for maximum impact. The data drop justifies the Greenland offer to skeptical Americans and Congress. It's not about ego. It's about securing 2 billion ounces for national security. It applies pressure on Denmark by showing Greenland is far more valuable than they realized. It forces China to show their hand. If China counterbids, it confirms they see Greenland as strategic. If they don't, the U.S. wins by default. And it spikes the silver price, which benefits U.S. mining companies and punishes short sellers, many of them foreign banks. I can't prove this coordination, but looking at the timeline and strategic logic, it makes sense. If it's true, it means the Trump administration is playing a more sophisticated game than the media gives them credit for. This is Robert from What Happened After. If this video opened your eyes to what's really happening in the silver market, do 3 things right now. 1. Smash that like button. 2. Subscribe and turn on all notifications so you don't miss our next update. 3. Share this with anyone who needs to understand the Greenland silver situation. Drop a comment and let me know. Are you buying physical silver, mining stocks, or both? I'll see you in the next one, where we'll be tracking every development in this Arctic resource war. Stay informed, stay ahead, and I'll see you soon.